Thank you very much for joining us today. The subject of today's talk is going to be, is the UK stock market undervalued? I'm going to give you a very early spoiler. The conclusion is yes, it is. But one of the things we're going to do is look at some of the reasons why it might be undervalued. Hopefully give you a bit of a kind of idea of the context and whether that might change in the foreseeable future. We're also going to talk a little bit about the US stock market as well. And just wrap up with looking at a little bit of a peer into the crystal ball for 2024. So without much further ado, let's get started. So it's actually quite a topical time, I think, to be looking at the UK stock market, because the FTSE 100, which is of course our headline index, has actually just celebrated its 40th birthday. So it turned 40 on the 3rd of January. Here are the long-term returns from the headline index, which are set over various time periods and against other kind of developed market indices. You can see that over the last 40 years, that the index has actually risen by over 5%. Doesn't sound too bad in absolute terms, but you can see compared to most competitors, that's actually towards the back of the pack, beating only Japan. And perhaps what you'll also notice from these numbers is that actually a lot of that the growth that we've seen in the FTSE 100 actually came in the 1980s and 90s. Actually, from since January 2000, as we know, the peak of the tech boom, the index has only risen by 0.4% per annum, significantly behind Europe and America in particular. So I think it's important when you're looking at these numbers, this is numbers for the headline FTSE 100, it's important to recognize what's not in these numbers and perhaps adjust for it. So what's not in these numbers is dividends. The headline index does not include dividends. Now, obviously, companies across all indices provide dividends to investors, but they're probably more important for the FTSE 100 because of the dividend traditions of many of the companies within it. So that's one factor that we're not seeing here. Another factor is that we're looking at returns in pounds and pence here. So this is what the capital return that a UK investor would have received from these various indices. But obviously that means that kind of currency movements affect this as well. And actually the overseas indices have benefited from currency movements. So we can actually kind of translate these numbers into a total return index, which is in local currency. So that is obviously kind of pounds and pence for the FTSE 100, dollars for the S&P 500, etc. And you can see that if we do that and if we include dividends, then we actually have a much better picture for the FTSE 100 over a lot of periods. So since January 86, so a little bit later than 1984, not quite 40 years because the total return series doesn't begin until 1986. But over that almost 40-year period, we've got returns which are kind of much more favorably comparable to the rest of the world. We can also see that if we look across right over to the far right-hand side, since January 2000, actually the FTSE 100 in terms of total return is actually ahead of Europe as well as Japan, if we're including dividends and in local currency. So things are looking a bit rosier if we look through this lens at the FTSE 100, which is probably a purer kind of measure of how the index has done itself for domestic investors in each one of these regions. I think what we can probably see as well is the two kind of highlighted columns there, is that actually while things look better over many periods, actually over the 2010s and 2020s, the UK still has been a laggard on the kind of developed market stage, so bringing up the rear, even if we do include those dividends. So that kind of encapsulates, I think, the performance over kind of quite a number of periods. Now, obviously, that doesn't necessarily speak to valuation. So we can say that over the last decade or more, the UK has been an underperformer. But what about its valuation? Well, one of the most widely used measures of valuation is cyclically adjusted PE ratio. So this is just like a normal PE ratio, with the difference that rather than just looking at earnings over a period of a year, it looks at earnings over the period of the last 10 years. The idea behind that is that it kind of looks at earnings across the business cycle, so you get less volatility, hopefully evening out some of the rougher edges of kind of earnings volatility. And what you can see is that the UK is on a cyclically adjusted P/E ratio of around 15. That compares to the US, which is on around 30. So just on the basis of those figures, you could say, wow, that's quite a steep discount that you're getting on the UK stock market compared to the US. And you know, that is true purely looking at those numbers. What you'll also see when looking at this chart, though, is that actually for most of this 40-year period, the US has traded at a premium. So that's actually relatively normal. You know, there's a number of reasons why that might be the case. Obviously, this different sectoral composition of the indices, different investor bases, and levels of liquidity. So what's probably a better idea, rather than comparing one directly with the other, is just to compare each with its own history. And you can see the average over this whole time period there on the screen in the two horizontal lines across the chart. And actually what this shows us is the overall picture is the same. The US does look expensive relative to its history. The UK does look cheap relative to its history. But the gulf is not quite as wide as if we just look purely at one versus the other. And that's probably a better measure of how these markets are relatively valued. So just to kind of touch on the US for a moment, we do have longer data from the US, courtesy of Robert Schiller at the University of Yale. So again, the blue line that you're seeing here is the same measure, the cyclically adjusted P/E ratio, but over a longer period. And what you can see there is where valuations are at the moment, as I said, just above 30 times cyclically adjusted earnings. You can see that they've been at this level or above for most of the last 5 years or so. But if you look back before that, to get to this kind of level, you have to go back to the tech boom of the late 1990s, or indeed the end of the roaring 20s, just before the Wall Street crash. So periods when valuations were exceptionally high, and generally speaking, bad things happened afterwards. That tells us again that, you know, US valuations are elevated, and perhaps even more so if you look on a longer time period. And the red line here you can also see is long-term interest rates, so the US government 10-year bond yield. And what you can see is that actually there's a fairly inverse relationship between interest rates and market valuations in the S&P 500. You know, the higher interest rates are, the lower the valuations, and vice versa. And you can see that taking place over the last couple of years or so as interest rates have risen. Valuations in the US stock market have been clipped, but are still pretty elevated. Now you might look at this chart and say, well, you know, so what? You know, valuations in the US have been elevated, but you can see they've been elevated for some considerable time, and actually performance has been strong. So why should I worry? And, you know, I have some sympathy for that, because the trends that we've seen in the US stock market are pretty long in the tooth, and it does seem to continue to go from strength to strength, driven, of course, by largely by a small cabal of large US tech companies. But nonetheless, it's been a successful investment. But if you do take that view, I think you then do need to have some sort of explanation for the next chart we're going to look at. So again, we're looking at the same measure here, the cyclically adjusted P/E ratio, which is the grey line, and overlaid with that is the red line, which is subsequent returns over the next 10 years from the S&P 500. So capital returns over the next 10 years. And what you can see is that there's a very highly inverse relationship here. So for instance, if you're looking at you know, the valuation in 2000, you can see that the market valuation is very high, and what the red line is showing you is returns over the next 10 years, so from 2000 to 2010. You know, if you aren't worried about US valuations in any respect, then you do have to come up with some sort of explanation for why this relationship, which clearly has held for a very long time, is about to break down. So I think that's a big question for anyone who is highly bullish about the US stock market. Just returning to the UK again, let's just go back to these numbers. So again, looking at the CAPE ratio. So as we said, the kind of the UK trading around 15 times cyclically adjusted earnings. So at about 14% discount compared to the US, which is trading at a 25% premium to their own long run averages. So what that shows you is, yes, the UK is undervalued, US is overvalued on this very widely used valuation measure. I've thrown in a couple of European examples as well to also show that while the UK might be undervalued, it's not the only place that's undervalued relative to its own history. Germany, in particular, is at a similar level of undervaluation relative to its own history, also going through a pretty tough economic time. So, the UK isn't necessarily the only place where you can find value opportunities. So that's, in a nutshell, the performance and the valuation of the UK stock market. As I said, as I gave the spoiler at the beginning, yes, the UK is undervalued. Let's have a think about some of the reasons why that might be the case. So the first one really is the economic context. These are projections from the International Monetary Fund. I wouldn't by any means expect for you to take these as gospel, but they do give you some idea of what is kind of baked into market prices and expectations at the moment. You can see the UK, three up from the bottom there, growth in 2023, very weak, and expected in 2024 to be pretty weak as well. Again, it's not the only area in the world where growth is expected to be weak. I'd also kind of highlight Germany again there, but it looks particularly weak, I guess, compared to the United States. And that's one reason why investors might not be willing to put money into the UK stock market. Now, I'm sure that some of you will be kind of screaming at your screens now, well, that's the UK economy, that's not the UK stock market. As we know, quite a lot of the UK stock market is international. Something like 75% of FTSE 100 revenues come from overseas. That rises to that falls to around 60% of revenues from FTSE 250 companies. So yes, the UK stock market does have lots of international revenues. One thing that I would say is that it still does have, while it might be a minority, it's a substantial minority of revenues coming from the UK. And in a globalized investment world, if you want to dodge that exposure, because you have, you think that the UK is a basket case, for instance, then you can easily do that. For instance, by slipping across to the S&P 500, obviously an index which has performed very well. But also which has around 3/4 of its revenues coming from the US and only 2% coming from the UK. So although the UK economy and the UK stock market are by no means synonymous, I do think that it's fair to say that the weak economic picture in the UK does have a knock-on impact on stock market valuations. And then just to show you that the IMF is by no means an outlier in terms of what it's expecting from economic growth. You can see here it's actually kind of it's pretty much in line with what the Office for Budget Responsibility is projecting. That's the blue line on this chart. And it's quite a long way ahead of what the Bank of England is expecting. You can see the Bank of England is very bearish there. If the Bank of England is correct in its expectations, we'd better hope that it's not. But that would be a very, very poor outcome for the UK economy. And we know that one of the reasons, why the UK economy may be struggling in 2024 is actually because of the actions of the Bank of England, raising interest rates as they have done. So actually, one of the kind of key factors in determining how the economy is going to perform is the effect of the central bank monetary policy. And just to give you an idea of how markets are currently expecting that to play out over 2024, there's been actually a really big shift in expectations downwards in the last couple of months as inflation has fallen away, and basically the market has said, well, we've reached peak interest rates, and has gone very far from that point to actually say, well, actually we're now expecting interest rate cuts. And if you look at this, it shows you that over the next 12 months or so, the market is actually expecting kind of 5 or 6 interest rate cuts in the UK. That feels pretty punchy to me, particularly when you consider that at the last Monetary Policy Committee meeting in December, 3 of the 9 members of the Monetary Policy Committee voted to increase rates. But I think, the market's probably looking at what's happening across developed markets, probably looking at what's happening in the US as well, and is thinking that actually, peak interest rates are behind us, and that we are going to get some interest rate cuts across the course of this year. I wouldn't necessarily take issue with that. I do think that there's quite some heavy discounting of interest rate cuts coming into the picture for 2024. But having said that, the expectations do inform many things, including kind of rates in the real economy, particularly mortgage rates, for instance, and we've seen those slipping back recently. And that's positive, of course, for consumers and for the economy. So that should be actually a positive thing for the UK economy, that expectations have fallen. There is a bit of a sting in the tail, I'm afraid, which is that the Bank of England reckons that of the interest rate rises that it's put through so far, only about half of those have so far been felt in the real economy. So even if we have reached peak interest rates, actually, there's still, unfortunately, a fair amount of economic pain to come through the system. And I think the next chart kind of illustrates why that might be the case quite neatly. This is research from the IFS and Citi. And what this shows is the kind of cumulative change in housing costs, both mortgages and rents, since the beginning of 2022. And you can see where we are at the moment, beginning of 2024. There's quite a lot of pain has already been felt in the housing market. What's quite interesting is that actually there's a considerable amount left to come, with the peak not really being until the beginning of 2025, so a whole year away. And the major reason for that is because fixed rate mortgages have become extremely popular in recent years, and people are still rolling off those deals. Something like 1.5 million people are going to roll off those deals in this coming year. They're going to get a lot of nasty letters on their doormats, and that's going to feed through into higher housing costs. So that gives you a good idea of kind of how we're still really not out of the woods in terms of rising interest rates for consumers or businesses, because of the fixed nature of a lot of that debt, even if we have reached peak interest rates. Interestingly, on this chart, you can see it dips up and then picks up again towards the end. I don't think that's because interest rates are expected to rise back over that period. I think that's probably because a lot of people took out fixed rate deals in 2021, which was the last hurrah of ultra loose monetary policy. A lot of those fixed rate deals were probably 5-year deals, and so those come up for rebroking in 2026, which I suspect explains why we're off to the races again in a couple of years' time. So, as well as interest rates, that's obviously a burden on households. Let's not also forget taxes are also a big restraint on households and, by extension, the UK economy. So actually the tax burden, which is a kind of tax as a proportion of GDP, is actually expected to rise to a post-war high in the next 5 years. That's despite the national insurance cuts that we saw in the autumn statement. So the reason for this is, of course, corporation tax has gone up, income tax and national insurance tax holds are frozen. The capital gains tax allowance has been cut, so is dividend allowance, inheritance tax threshold has been frozen. All of that just means more and more pressure on consumers and businesses, of course, and that again is a further constraint for the economy. So that kind of builds a picture of kind of a lot of struggles, I think, with the UK economy, a lot of headwinds still, and a lot of progress yet to be made. So I think that's one aspect. That kind of economic picture is one aspect of why valuations in the UK stock market might be at such a low ebb. I think another reason comes down to current investing trends. So this is data from the Investment Association, and this shows you the kind of retail flows into or out of UK equity funds and global equity funds. And you can see that, UK equity funds have been deeply out of favor for some considerable time. Ever since 2016, UK investors have just been selling down relentlessly UK equity funds. So I don't know if anyone can think of anything that might have happened in 2016 that might have been the catalyst for this change. But anyway, the trend is pretty clear to see. Actually, around £44 billion withdrawn from UK equity funds over this period, and a lot of that finding its way into global equity funds. And of course, kind of money coming out of UK equity funds. Well, what does that mean? Well, it means the fund managers of those funds are selling shares on the London Stock Exchange to meet redemptions and give investors cash. And that means selling UK equities. And that obviously kind of has a negative impact on the UK stock market. Money going into global equity funds has an opposite effect on the global equity stock market. So I think obviously there looks like there's no sign of this trend abating. Actually, it's accelerated in recent times. Part of why this is happening is probably a bit of a self-fulfilling prophecy. It's a bit that performance from the UK has not been as good as global equity funds, and so investors look at the performance tables and they think, well, why should I invest over here when this is doing a lot better? So that's definitely part of the puzzle. I do also think that there's been a shift in investment opportunities available to investors in the UK and globally as well, and also a much greater awareness of global benchmarks as well. I'm sure that some of you have seen this, in the kind of model portfolios, multi-asset funds, everything that you manage investment-wise, is that actually it now has a much more of a global flavour than it did say 20 years ago. And I think that's because, as I say, the investment opportunity set has opened up. If you think about 20 years ago, most fund groups, their kind of flagship fund was a UK equity fund. You think about the big fund managers of the 90s and the noughties. They were people like Anthony Bolton, they were Neil Woodford, Bill Mott, Richard Buxton. These guys were running the big equity funds. They were the big dogs of the investment world. And that's just not the case anymore. Actually, the UK equity offering is just one of many investment options that fund houses offer. And in terms of this trend, I think that is significant. And also that, as I say, that idea of being benchmarked globally. So this is a kind of snapshot of where we are at the moment in terms of funds under management for the investment association sectors. And you can see that even despite those very big outflows that we've seen, UK all companies is still the second most popular sector held by UK retail investors. And I say that's really a legacy of the past, when actually in the 90s and noughties, what people were buying and what fund groups were selling were those big UK equity funds. But actually that is pretty out of kilter with how the developed global market looks. So, if you are looking at opportunities elsewhere, you could probably find funds that have performed better than the UK. And also, if you're taking a kind of benchmark aware approach to your investment, what this shows you, is that at an aggregate level, UK retail investors are still overweight UK equities by quite some considerable margin. And that actually, if they're unwinding that, then actually there's quite a way to go. And if we look at where the UK sits in terms of the global market, this is where we're at. So this is the MSCI World Index. This is probably the most widely used global stock market index. You can see that the UK there is there at 4%. It's less than either at Microsoft or Apple make up individually. It's significantly less than the Magnificent Seven, the big 7 tech stocks of the US, which are almost 20% of the global stock market. I haven't even put the US stock market on here because I wanted you to see the detail. But if I put this on here, it would be up at somewhere around 65% of the UK, of the global stock market, developed stock market, is made up of the US. So you can see from that again, the UK, is no longer a big part of the US of the global stock market. You look back, say, just over 10 years, and that figure stood at somewhere near 10%. So that there's been a big change there. And in a way, again, you can see how this becomes quite deeply entrenched and how it can be a bit of a self-fulfilling prophecy. Because if you're a global fund manager, you can actually not have any exposure to the UK without taking a huge amount of risk relative to your benchmark. You can't really do that with the Magnificent Seven, and you can't do that with the US stock market. So I think it's kind of worth being aware, maybe, and that shift that we've seen in investment, and obviously part of that is also the shift that we've seen towards passive investing, which of course invests purely along in terms of market capitalization, so the size of countries and the size of companies, and just to show you how passive funds have grown. You can see that particularly over the last 5 years, again, this is data from the Investment Association, you can see that actually passive funds have seen kind of consistent flows. Active funds have been a bit up and down, but over this period, we've seen around 75 billion pounds go into passive funds, and over the kind of last 5 years, we've seen 9 billion pounds in aggregate come out of active funds. And again, you think of what that's doing at a market level. Well, those passive funds are just throwing money into companies based on their size. So it's giving more money to big companies, giving less money to smaller companies. So again, you can see how that entrenches that that kind of virtuous or vicious cycle, depending on which side of it you sit, and how the UK, for a global tracker fund, is now getting 4% of that money, where the Magnificent Seven are getting 20%, and the US is getting 60%. So that is supportive of those markets. So I think also just worth being aware of those investing trends which have taken place, and which also might be featuring, might be a reason or a factor behind the valuation of the UK stock market. The other thing I wanted to highlight on this chart is flows generally over the last 2 years, if you're adding kind of active and passive together, have been very weak. 2022 was absolutely shocking. Never seen before that level of negative flow, even in 2008, from funds. And one of the reasons that you might think is behind this is that people are now moving into cash. I'm sure that many of you are probably having conversations on this subject with your clients, where they're talking about well, I can get 5% on a cash bond. Why should I be investing? And I think this is quite an interesting chart, which shows you how flows into cash deposits, including NSNI, have changed over the last few years. So you can see the very big bump in kind of during the pandemic, where it was locked down, we couldn't go out to pubs or restaurants and hairdressers and spend our money, so we saved it. I mean, I haven't been to a hairdresser for about 20 years, but I'm reliably informed that in normal circumstances, people do go to hairdressers. That wasn't happening in that period, and that meant that we were all able to save considerable amount of money, and then that kind of returned to normal as we were able to go out and spend on lots of stuff. Actually, you can see that amount kind of tailing off towards the end, and that actually not a huge amount has been saved in 2023, and I suspect that's because we are just getting to the very sharp end of the cost of living crisis. Those pandemic savings have been used up, and actually people are just making ends meet. So actually we haven't seen a huge amount of aggregate saving over 2023. Now, I think this is aggregate data, so I suspect within this there are some haves and some have-nots, and that actually kind of there has been money flowing into bank accounts and savings accounts from wealthier individuals, but that's being drawn down on by less wealthy individuals. But I think the thing that's interesting as well about this chart is the fact that if you look over on the left-hand side of the chart, interest rates are at about 0. If you look over on the right-hand side of the chart, interest rates are about 5%, and yet there's not a great difference in terms of the money that's going into cash accounts. And as I say, that's probably because of a lot of pressure on households, and that maybe actually there's still some way for that story to go, and that when disposable income does come back, actually people plump for cash rather than investment. And as I say, I'm sure that you're having these conversations with with customers at the moment, around cash savings, and of course they're very attractive, very tempting yields at the moment. If we look at data from the Barclays Equity Gilt Study, you can see that over a 10-year period, equities outperform cash 90% of the times. That's kind of data going back to 1899. So it's not just looking at the era of low interest rate. There's lots of interest rate periods over there, so it's a good sample. But I think nowadays you do have to make that argument more robustly. Whereas when interest rates were at 0%, it was just a no-brainer, wasn't it, not to put your money in cash. So again, just one to keep an eye on there. So just to kind of wrap up on this kind of subject of the UK valuation, thought I'd leave you with a Buffett quote. This is actually Buffett actually summing up the investment approach of Charlie Munger, in fact. And I think it helps to contextualize a little bit what we've been talking about. So your wonderful company, the US is your wonderful company. It's got these very, very resource rich companies that are bashing out amazing earnings growth, seem to have very high barriers to competition. So that's your wonderful company. I think the challenge for investing in the US is it at a fair price? And I think based on the valuation data that we saw at the beginning of the presentation, you'd say no, it's not at a fair price. It is at a premium. You might still be willing to invest at that premium. But certainly compared to your historical average, you're paying above average for the US stock market. You're getting a wonderful company at an elevated price. Now, the UK stock market is the market that's the company that's trading at a wonderful price. Is it a fair company? Well, we've seen from the economic picture doesn't look great. In some ways, the economy is cyclical. At some point, the UK economy will pick up again. Please God, let it pick up again. But we can expect it to be cyclical, and actually, in a way, that's perhaps less of an issue because that's just a question of being patient. Maybe some of the kind of more secular trends in investing are a bit more long in the tooth and might be a bit more of a pause for thought, because if you're buying something at a wonderful price, in order to realize the value in it, the rest of the market really has to come around to your way of thinking. If that's the case, then, and we've got these kind of trends that is kind of relentlessly selling down the UK, then actually, that trend may have further to run, and it may be that you have to wait some considerable time and be very patient in order for to realize the value from the wonderful price that you are getting. That's not to say that you shouldn't invest in UK equities, but people have generally been pretty patient up to this point, just saying that that a turnaround might not be imminent. And I think for both your wonderful companies and your fair companies, as we said at the end there, cash is much more of a competitor nowadays. So maybe that's also going to be a bit of a drag on returns going forward. So that's the end of our look at the kind of UK stock market in particular and that question of valuation. Just wanted to spend a little bit of time looking forward to 2024 and particularly thinking about the big theme of this year, which is going to be elections. So something like half of the world's population going to the polls in some shape or form over the course of this year. Two big ones from our point of view, of course. One is the US election. So that's going to start kicking off in earnest shortly, with the US primaries kicking off, Super Tuesday in March. There are some big things that are probably going to be front and center of that election, which are going to have big effects on markets. Things like America's position on Ukraine, for instance. And geopolitically more generally, what's trade policy going to be like? What's the relationship with China going to be like? I mean, Trump is associated with protectionism, but Biden's really picked up and run with that mantle. Also issues over are there going to be tax cuts? We know that last time Trump came in, he enacted tax cuts, and green investing. Another one of the themes which are going to be potentially affected by that race. Here in the UK, we've got an election as well. Couldn't help but put in that lettuce. I really do hope that the Daily Star revives that lettuce somehow from the bin in the forthcoming election campaign. So, at the moment, of course, it looks like Labour are on course for a victory. It's at the moment it's pretty hard to put any blue water between the two major parties in terms of their economic policy and in terms of what that might mean for markets. I think that Labour are probably playing their cards pretty close to their chest for as long as they can, and that kind of makes sense, doesn't it? I think from the point of view of what the Conservatives are doing, obviously, they're trying to overturn a very big change in a very big deficit in the polls. So, I would suspect that if they can, they are going to try and initiate tax cuts in the forthcoming spring budget. They're going to need a windfall from somewhere to do that. So, in the autumn statement, the Chancellor was basically spent all of his windfall that he got from the OBR. So they are hoping for another windfall in the forthcoming March budget. It looks like they might actually get one. And the reason for that is because of that chart we saw earlier, which is interest rate expectations have fallen, and that reduces the cost of government debt. So they might well get a bit of a windfall in terms of the fiscal picture, which may allow them to push through some tax cuts in March. Wouldn't expect a huge amount, but maybe a signal of intention. And then who knows what's going to come in the manifestos. But as I say, kind of not a huge amount of blue water in terms of the two parties in terms of economic policy as yet. I suspect that will change. And everyone kind of really expecting a Labour victory, aren't they? But just remember that funny things can happen on the election trail. Remember Gordon Brown and Gillian Duffy, the lady he referred to as bigoted on a microphone that he thought was turned off. Remember Ed Billerman and that bacon sandwich, which did for him. So funny things can happen, and they're not always entirely politically significant. And the other thing to bear in mind is that the margin of victory probably matters quite a lot. So, at the moment, the bookies are giving 3-1 on a minority Labour government. And I think that that's something that the markets wouldn't like particularly. So, if there's a kind of fairly centrist Labour government, that's probably not something that's going to spook the markets massively, because actually it probably means that we arguably get more political stability for investors and for businesses than we've had in the last few years, for sure. But if there's a minority government, then that kind of leads to, how long is that going to last? How strong a government is that going to be? Is it going to be able to enact any of its policies? So just a little bit of food for thought there in terms of what the various elections might mean. No doubt we'll get more details to dig into as we go through this year. So thank you very much for listening to all of that. Just the risk warning at the end. I hope that you enjoyed that and that it hopefully was useful to you. So that's it from me. Hope you have a good 2024, and no doubt that we'll catch up with you later on in the year.